So, good day, everyone, and welcome to the Forex Basics session. We will be going through Forex Basics from the beginning of what Forex is all about. One thing I want us to understand is that one way or the other, we are involved in Forex, especially if we have traveled out of our present locations or traveled into our present locations. We have been able to deal with Forex one way or the other. Now, what exactly is this Forex? When we say Forex, what exactly does it mean? It's actually it's the full meaning is foreign currency exchange. Foreign currency exchange. So you're exchanging foreign currencies. Foreign currencies, the exchange of foreign currencies between people and nations and governments and all of that. So in short, they call it FX or Forex. You know. So it's a process whereby a currency leaves a particular nation and is converted to the value of the other currency in another nation. So if you travel, for instance, from United States of America to the UK, in the United States of America, we use the dollar. If you go to the UK, we use the pound. Now, for you to be able to buy anything, to perform any kind of transaction in the UK, you need to convert your own currency, that's the dollar, into the UK, United Kingdom currency, Great Britain pound. That is the only way you will be able to spend in any of the places there, maybe to buy grocery or to buy water, whatever it is that you want to buy. So that process of exchange between two currencies is called foreign currency exchange. Now, it is the largest financial market in the entire world. I know some of us already know about the stock market. Yeah, the stock market, we have that. A lot of us know about it. Some of us even have stocks that we bought. But the Forex market is a very liquid market. There is no place, there is no location or a building or for sale where all the transactions happen. Unlike the stock market where we know that there's a place where they make all the transactions happen. But Forex, all you need to have is your internet, in your home, in your computer, and your can be connected to any trader all over the world. It is a $5.3 trillion daily market, meaning that's the amount of money that is exchanged, that is exchanging hands daily. So that's what is available to you as a person daily. If you have the right kind of skill, the right kind of strategy, you can plug into this huge amount of money, and get a share of it. Even if you want to maybe take like 5,000, 10,000 daily, it is possible if you have the right kind of strategy, the right kind of tools and resources. You can actually plug into this daily because it is open 24 hours, 5 days a week. So it means you can actually decide to make this your full-time job. You work from Monday down to Friday, and you're making money out of this. Even if some people can even make this 1,000 a day. So out of this $5.3 trillion daily, this is what you can decide. Even if you want to be making $1 million a day, so it's really up to you, whatever it is that you have, whatever goal you have for yourself. But then it means you have to study the market, you have to learn the ropes, you have to get your hands dirty and understand what this is all about. Now, like I said, it's open 24 hours, 5 days a week, unless the other side, there's a crypto part of it, cryptocurrencies that some brokers do Saturdays and Sundays, making it available 24 hours, 7 days a week. But I don't really do crypto anymore. Crypto is very volatile. So as a beginner, you are not advised to do cryptocurrency. Just stick to the Forex, because Forex is a little slow on some days compared to cryptocurrency. Now, it covers major trading sessions. So what that means is that there are different trading sessions. You can, if you choose to be to trade in the morning, if you choose to trade in the afternoon, if you choose to trade in the evening, or you choose to trade at night. If you're that kind of person, the forex market is always open. It doesn't close. It's there 24 hours. You have the New York session, you have the London session, you have the Asian session. All of that. Those sessions are available depending on when you want to work. So you can even have two jobs. You can be at your place of work in the morning, then in the afternoon or in the evening, you can come back to trade forex. But the truth is that some sessions are more volatile, have more liquidity than other sessions. Some sessions are slower, especially we'll treat a little bit, we'll go much into more details with the sessions at a later session, at the later session. But some sessions are more volatile. By volatility meaning they are faster, they move better than other sessions, especially the Asian sessions. They can be quite slow, so like I said, I will treat more about it. So which allows you to manage your time effectively. So like I said, you can do a couple of jobs and still be able to trade your forex at the same time. So the next question is, what exactly do we trade in the markets? Now, we trade foreign currencies in the market. You know about the pound, you know about the yen, you know about the euro, you know about the dollar. So all of these currencies are exchanging hands daily, whether you are traveling out, whether you are even sitting at your own home to make these exchanges. They are happening. These are the currencies. They are the world currencies that are being exchanged. Now, there are some currencies that are major currencies. There are some currencies that are minor currencies. There are some currencies that are exotic currencies, but we'll treat these ones in later time. Now, the price of currency shows the strength or health of a country. Now, what this pretty much means is that the country determines the health and strength of a particular country. Now, they say the dollar is strong. It means that the U.S. economy is strong. So the dollar is weak means the U.S. economy is weak. So what you're pretty much doing as an individual, you're buying the shares, like you buy shares. Remember we talked about stock earlier. You're buying the shares of that company, that country. So if the country's economy is strong, so it means that you're buying that currency. If the country's economy is weak, you're selling off that currency, which is pretty much what forex is all about. It's all about buying and selling. Some people are buying and some people are selling. So they are both sellers and buyers in the market. So that's one thing I want you to also note. Also, the exchange rate of a country in relation to another reflects the country's economic strength. Yeah, exchange rate rates when you're trying to there's the exchange rate between dollar and yen. It's different. The higher it means that okay, maybe that economy the economy has strength. The lower means that the economy is weak, so they're trying to trying to manage it in terms of inflation and all of those kind of things. But that side, a whole lot of that side is fundamental. But we'll do a lot more when we go to the later stages, sessions. Now, currencies are affected by economic activities, political activities. That is very true, because if, for instance, now there is war happening in a particular country, I'm still using the U.S. now. Why? Because that's the country where your local country at this point. So if there is war outbreak in your country right now, you would see that your dollar's value is going to diminish. Why? Because a whole lot of people will be selling whatever dollar they have, because they don't know what is because of the uncertainty that is surrounding that country. No, you would not see a lot of investments happening. In fact, people will be running out. So that those kind of things can affect your currency. If there are political issues, for instance, if the time when we had voting, change of government, when Trump came into the picture. So I can assure you that there were instability as a result of that event. So it would have affected your dollar in terms of people. Because some people may not have liked Trump. Trump coming in will be like it will be an uncertainty to a lot of countries because of the kind of personality that it is. Of how United States of America, if Trump is going to become president, it's going to be a very big a negative blow to the economy. So a lot of people will start selling off the dollar. You see the dollar start becoming very weak. So political activities, economic activities can actually affect your dollar, the currency of whatever country that you find yourself. You can make money forecasting that the currency is going to fall or is going to rise. That's true. So if you were actually reading the news and you saw that Trump is going to become president, in your mind, okay, based on that analysis, you now decided, okay, I'm going to sell off all of my dollars that I have, because I know that if Trump becomes president, the dollar is going to fall. So the truth is this: if your forecast is accurate, you will win. So eventually Trump becomes president and the dollar falls. That you made a lot of money because of that forecast. If Trump becomes president, the dollar doesn't fall, you will lose a lot of money. It's basically what it is in the market. So you're either winning or you're losing. So now the truth is this: as a forex trader, you can win on both sides. That's the truth. So I want you to understand that you can win on both sides. Whether the currency is dropping, you can win. Whether the currency is going up, you can win. Why is that possible? Because you're buying. You can buy and you can sell also. You can sell it when it's going down. You can buy it when it's coming up. So that's the good thing about it in comparison to trading stocks. If stock is going down, you're losing money. If it's going up, you're making money. But if this one, for forex now, if it's going up, you can sell. You can buy. If it's coming down, you can sell to make money both ways. Yep. So also currencies have two letters. They have three letters actually. That's you have the USD, US dollar. Let me have this. Let me see, Blazer. So you have this US dollar here. What does that mean? It means that the first two letters here means the country where that currency is from. Then the last one here means the name of that currency itself. It's all throughout, all the currencies have that nomenclature. So the US dollar, so United States dollar. So you buy one currency, sell another, and vice versa. That's what really is. So you're buying one currency and selling the other. So when you're buying, for instance, you have two currencies, USD, JPY. That is USD, US dollar, and JPY is Japanese yen. So if you're buying USD, JPY, it means you're buying USD and you're selling JPY. I repeat that. For instance, if you had a USD, okay, let me go to the next screen so I can show you what I mean. So take something like this, for instance, card JPY. Okay, let me use something that may be a bit simpler. Okay, let me use this one. You will eventually get to know them. This is card JPY. This is Canadian dollar versus JPY, Japanese yen. Remember what I said, that the first two numbers, the first two alphabet here represents the country where the money is coming from, and the last one here is the last letter here is the currency's name itself. The first two letters, remember, Japan, JP, and the last one here is the yen. It's called the yen. So if you're buying card yen, for instance, right now, card yen, card JPY, if you're buying this card JPY, what you're pretty much saying is that you're buying into the value of the card, meaning that you are telling us that you know that the card is going up and the yen is coming down. That's what that means. If you're buying the euro chef means that euro, I think in this case is where there's an exception to the rule, because C chef means Switzerland, C7 means Switzerland. You can't find SW here. CH is where you find, but the name of the currency is called franc. So the Swiss franc is the currency. This one is actually euro. Euro is the name of the currency. But the rule may not really apply to this one now. So if you're selling euro chef now, for instance, what you're saying is that you know that the value of the euro is coming down, and the value of the chef or the Swiss franc is going up. So that's why you're selling. So you sell the first person, you sell the first currency, and you buy the other currency. That's what pretty much it is. But don't get confused. We're going to get, the more you use it, the more you understand. So I'm just going to take it one step at a time. So now back to where we were before. What's traded in the forex market? They are what they call the major currency pairs. The major currency pairs. Okay, I think I did not just try. Okay, I'm just gonna. I'm gonna. I'm gonna give another step because slide is faulty. Now the major currency pairs, you should see something like USD JPY, maybe Euro JPY, GBP JPY, GBP Chef, CAD Chef or AUD, all of that. I'll give you a different slide that has that combination, but this is just to show you the names of those currencies. And yeah, I would make a change of this slide. This slide is incorrect. This is not the major currency pair. This is just the name of the pairs itself. So this is USD, US dollar. This is euro. This is JPY. This is Great Britain pair. This is Swiss franc. This is CAD. This is Canadian dollar. This is Aussie dollar. This is New Zealand dollar. So you see their currency name and you see the nickname that they call them, but don't bother yourself about the nickname. Some people use the nickname, but you don't really need to bother yourself about the nicknames. Just know that these are the names of those currencies. You know, so when they put them together, when this one and this one come together, become something. Now, when you start using them, you would start seeing how they come together, how you marry them together. Like you can't see USD euro, you can only see euro USD. You can't see JPY euro, you can only see euro JPY. But I'm sure, like I said, the more you use it, the more it becomes, because they are all available to you in that MT4 that I asked you to download earlier. You'll see all of these currencies on there. So the minor currencies, these are the minor currencies. You should have seen the major currencies, but I think I misplaced that slide. But this is the minor currencies. What do I mean by major currencies and minor currencies? Major currencies are currencies that are available everywhere, that everyone is trading. It is widely traded. Major currencies are currencies that are widely traded, meaning that all over the world, traders are, those are the ones that people are really trading. Now the major one that is everyone is really trading, like right now, the number one on the list is the Euro USD. Euro USD, that's this one and this one. These two currencies are the ones that are majorly traded in the market. You know, so you would you will see that when we go into the, or let me just take you to the MT4 right now so you can have an idea of what I'm talking about. Okay, now this is an example of let me see if I can use this guy. Okay, so this is an example of what an MT4 looks like. Yep, it's an example of what an MT4 looks like. So just our currencies now. If you look on the left, okay, look on the left. What do you see? You see USD Chef, GBP USD, Euro USD, USD JPY, USD CAD. So these are example of major currencies that are traded. And you now find currencies that are crossed over. You know, the reason why they are called crosses or minor currencies are they are not traded as much as these other ones are traded. They are not traded as much as these other ones, and you will notice these ones that are greatly traded, you see that they are cheaper. This thing on the right hand side here is called spread. You will do a lot of it. You will do more of it when we come together again. Spread. You see they are cheaper than the ones on this side. You can see this one, you can see them in 20s, 25, 30. But these ones you can see 9, you know, because why are they cheaper? Because so many people are trading them. So many people are trading them. That's why they are cheaper. But if you have fewer people trading them, they will be more expensive because they need to. It's all about the exchange. It's it's just the exchange that makes it much more expensive anyway. Now, another type of currency I want to show you is what they call the exotic pairs. Now, these are the pairs that are not very much traded. which makes them even much more expensive than the minor ones. They are not as traded as the other ones, the minor currencies or the major currencies. Example of those ones are things like this, like we've seen here. You can look at the price, see how large their prices are. 2018, 1,441. So there are things like the euro, Hong Kong dollar, euro. I don't know what's the Hungarian forints. You have the euro, Norwegian krone. You have different currencies. Some of them you don't even know that they exist. Euro Mexican peso. Yeah, they are all exotic currencies, but you will find them in the market. But what we advise traders to do, especially the new traders, is just to concentrate on the major and the minor currencies. To forget about the exotic currencies because they are too expensive to trade. So the next one on here is what we'll be looking at: the participants. Who are the people that even trade this market? Who are the people that are in the market trading the forex markets? Now we have large banks. There are banks like JP Morgan, Barclays, HSBC. These big banks, they are the ones that have the liquidity. They are the ones that have the money. They are the ones that move in 10 billions, 20 billions, 30 billions, 50 billions, because they have the money. They are trading for a whole lot of people, for themselves, and also a whole lot of clients that they are all managing. So they have the finances. Now I want you to understand something, to write this down. Very, very key. Very, very key. The big banks, the large banks, are the ones that really move the market. They are the ones that move the market. The large companies, large corporations, governments, they are the ones that move the market because they have a huge amount of money. They are constantly trading. They are trading between banks. They are trading between companies. They are trading between governments. So they are the ones that really have the finances to really move the market. So I mentioned large corporations like Microsoft, Amazon. They put money out there. When they put money, they are putting money in 30 billion. They're putting 500 million. That's the money that is coming out. So they are the ones that really move the market. You have governments. You have central bank. They are the ones that really have impact on the market. Then you have the retail traders, which is you and I. You and I are classified as retail traders. You have to write that down as well, because we are the ones that pretty much take the crumbs from the market, because some of us will not be able to come into the market with 5 million, even to start with $5 million. We don't even have that to even start something as high risk as this, which brings me to the fact that market trading, forex trading, is a very high risk platform, a high risk industry. So if you want to write that down, so that every time you always remember, before you jump into a trade, remember it's a high risk industry. You can lose all your life savings trading forex if you are not properly risk managed. If you don't have the right psychology, you would lose everything that you have, because you're constantly chasing the market. You just want to chase the market. You don't have the right tools. You don't have the right knowledge to jump in, which is why you are here to learn all that there is to learn, to be able to understand what to do when you enter the market. So you and I are retail traders. We are classified as retail traders. Another thing I want you to write down is the fact that we do not move the markets. Retail traders do not move the market. So don't expect to have any impact on the market. So you want to buy the market so that it can go up. That is not your place. What you want to do as a retail trader is to follow the market movers, follow the banks. What are the banks doing? How are they trading? What are the governments doing? What are the large corporations doing? That is why you need to also consider fundamentals. What are fundamentals? They're talking about news releases not necessarily on TV. I don't really watch TV anymore as much to look for news. We have this website that we go to look for news like from the European Central Bank, news from the Bank of England, news from the Bank of China, Federal Reserve news. So all of this news, they are the ones that affect the market. So when they happen, they drop a number of pips. Pips, you will learn about what pips is. So I'll show you an example of what news can do. If you look at an example of charts, this is what a chart looks like. This is what it looks like On a normal day, this is what you have to learn. This is what you have to learn to understand. Trust me, when you look at this, it will look like rubbish. It doesn't make sense to you. Why are all of these lines happening here and there? If you've never actually looked at it, you won't really understand what's happening. This is normally how they move. Now, when you see something like this is an example of news. This is an example of news. News will make this thing jump like this. Now, when it's going up, you're buying. When it's coming down, you're selling. I just want to give you a tip of the iceberg. So let's say this thing is coming down like this. It means that you're selling. For instance, it now goes up and it goes up this much. Let's say you had what they call a standard loss size in the market. Let me give you an example. You have a standard loss size in the market. You see where this thing got to? It got to, I can count this to be 142 pips. Counting pips now, you would get to understand what pips mean. This is 142 pips. Now, if you had a standard loss size of $10, what that means that's you'll be making $1,420 in just one day trade or 1 hour, because it took how many hours? Let me see how many hours it took for that move to happen. If you were in the right place and you were buying this market, in just 1 hour, it moved to 1,000. You made 1,420 pips for 20 pounds. Sorry, dollar, because of where you are. $20 in just one trade. So that is very possible. Yep. So I want you to understand that as a UC trader, you have to move with the crowd. What is everyone buying? What is the large banks? What are the large corporations? What are the government doing? So that's why you need to study the market to understand the way they are moving. To also look at the fundamentals as well. But all of this you will learn as we progress. Now, after that, we're going to look at the brokers. Brokers are like intermediaries. They are the ones that connect you to the market. They are the ones that connect buyers and sellers together. So because we have buyers and sellers in the market, we have them there. We are people that are there to buy and people that are there to sell. So even you as a trader, you can be a buyer, both a buyer and a seller at the same time. Remember what I told you: when it's going up, you're buying; when it's coming down, you are selling. So that's who you are. You can sell and buy at the same time. So a broker is the one that provides you with the leverage to be able to enter the market. Remember what I talked about these guys? These guys are the big boys. We call them the big boys. They are the ones, they call them the big money, smart money. They are the ones that move the market. They are the ones that throw in the liquidity. Without the help of the broker, you cannot trade in the market, because you may not even have the finances to be able to make that trade. So the broker offers you what they call leverage. We'll look at that in much detail when we get to the session of leverage. They're the ones that give you the support, the money that you need to be able to enter the market, to trade with the big boys, you trade with the market movers. That is the place of the broker. They help you to deposit money into their own account, and they use that that money you trade, they keep it for you. When you make an order, they execute that order for you, and if you win, the money is yours. If you lose it, it goes to whoever bids that wins you in that market. Now, for how do they make money? They make money through what they call commissions and spreads. Like for instance, look at this I was showing you earlier. This thing here is called spread. Spread, meaning that this is what the broker is charging you to be able to trade it. So if you jump in, they're going to charge you what they call 9 pips. For this what's it called? Is it not 9 pips? Sorry, 0.9 pips. 0.8 pips for that trade that you just entered. So that's how much they are going to they are charging you. You also sometimes they also charge you commission on a particular position that you open. That's the way they make their money. Just a small amount of money from what you are trading. So now you should have what they call criteria for choosing a broker. All of these things may sound too much for you at this point in time, especially if you have never done it before. But trust me, as you progress, you will hear these names, you hear these things over and over again. They will become part of you, And also, I want you to also understand that not all of this information that you're going to need used to trade, but you need them to have a knowledge of it. So when you're entering the market, you know what you're doing, So for us, what is the criteria for choosing a broker? They have to be regulated. Now, Why do they have to be regulated? They have to be regulated because brokers are not to be trusted. None of the brokers, this is something that you have to write down. You cannot trust any broker. You cannot leave your money with any broker. If you find out that something is fishy, then it definitely might be fishy. If you feel something is fishy about what is happening to your position or your money, it might be true. So that's why you have to ensure that you get a regulated broker. A regulated broker is one that governments have some form of influence over, so that if something happens by adventure, they can penalize them, and they can either make them refund your money, or even if they pack up business, in some cases the government is able to give a refund to some clients some of the brokers' clients. So another criteria is execution time. When you click a position, maybe I was in this position right now. Let me see where I am. I was in this position and I thought this market was going to go up, and I click it, and I do for instance, I say buy. Let me see where I am now. So I say this position. Let me just check something out. 5 minutes time frame. Okay, this market is going to be slow because we're in the this thing session now. So let's say I'm looking at this market and now decide to buy this market. I need to hear that immediately. You know what? The moment I put that in, let me bring that up again. So the moment I'm going to do that again. So the moment I do this, click buy, it must enter immediately. It mustn't waste time. The moment it wastes time, there's something wrong. So that's what they call it, execution time. Execution time must be sharp, because unlike what it used to be before, when they used to sit on the when you do in terms of maybe when you trade stock, if you need to call the broker and all of that. This one you don't need to call the broker, you're doing it live and direct. So you just need, once you click, you need to see the outcome immediately. You need to see the price at which you clicked it. It needs to reflect there. It doesn't need to waste time. So that's what that is. Execution time is. Transaction cost. How much is the spread? How much is the commission? Different brokers have different spread. Some of them is cheaper. Some of them, this could be 0.5. Some of them, this could be 0.9. Some of them, this could be 12, because that's where they make their money from. Yep. Now look at that position I entered. See, if you see it's going positive, means I'm making money. You see, I entered a buy now. So you see, this one is negative, means I'm losing money. So this one is negative, means I'm losing money. So this one is positive, means I'm making money. So I've just made myself 18p now. If I had a standard in now, that would have been maybe like 1.8 pounds. So this is going very well in my favor. Because I was buying this. Isn't that good? So now if I close this, my money would have increased, by some amounts, but look at this one, I'm losing money here because it's minus. So that's an example of how these things run, but we'll look at that later. So if the transaction cost is high, you need to consider whether maybe another thing is, there's one thing that you also have to bear in mind, is that some of these brokers, if they are not regulated, they will make their transaction cost very low so that they can attract you. But if they are regulated, their transaction cost may be high. It's just on some occasions, because I know some of them that are regulated and their transaction cost is low as well. So customer support, you want to be able to call them anytime you have an issue with your position. Just call them. If you don't have a way of contacting them in terms of phone number, email address, or any of those things, then you have to be wary, because it means that if something goes wrong, there's nobody to speak to. Then withdrawal and deposit. So you need to be able to deposit money easily. Maybe within a few minutes or a few hours, your money is available for you to trade. And you need to be able to withdraw easily. Not that after they collect your money within 1 hour. If you now want to withdraw, it takes them five weeks for them to give you back your money. Then that's fishy. So how fast, I know it may not be easy for them to withdraw that fast because of other parameters that are involved, but then it shouldn't be so long. Just look at the number of days. If it's 1 to 2 days, that's good enough. But if it's a whole 2 weeks, that's too much. So trading platform, do they have a tradable, a user-friendly trading platform like the one we talked about earlier, the MT4? That's a very good one as well. So do they have a user-friendly MT4? That's one of the criteria you have to look out for when choosing a broker. Now, I talked about trading sessions. Remember, I talked about trading session, that the market is open 24 hours, but this 24 hours is broken down into different sessions, into different trading sessions. You have the Sydney, the Tokyo, the London, and the New York session. But sometimes these two sessions are classified as one, the Sydney section and the Tokyo session, because it's pretty much they are in Asia, so it's pretty much, we call them the Asian session. So sometimes people are sleeping at this time anyway. You have the London session and you have the New York session. So Sydney sessions, 10 a.m. GMT, all of these numbers you can convert to your own time, to know what the CST will be. So, but these are the sessions that are available in the market. Now you have sessions that overlap. Now, this is where the high liquidity comes into play. Yeah, you will see when two sessions overlap, this means there's a whole lot of money available to be made in that time frame. That is why you have them like this. I've already put them out here, but like I said, all of this, you don't need to cram them. You just need to be aware of them so that when you start using them, they will become part of you. But just know that there's such a thing as session overlaps, and at the session overlaps you have high liquidity and increase in market volume, meaning that you can make a lot more winning in those crosses. So that is the end of that session. I would welcome questions now.